I want to shoot a question to all of you. Who are the backbones of our nation? Some say farmers, some say engineers, some say soldiers, some say all the three. But beside them, there are another section of people who can also be called the backbones. They are none other than the honest taxpayers. Yes, they are contributing their part in building a healthy economy. By the end of the day, they suffer, as the most portion of their income will go in the name of tax. For such people, in this video, I want to share few tips to save tax. Hi, my name is CA Jithendar Patel and I am on a mission to help small and medium enterprises with effortless statutory compliances. Many business owners opt for tax avoidance rather than tax planning. Tax avoidance could be dangerous. Where tax avoidance is also illegal, tax planning is legal. In this video, I am going to share 5 ways to save income tax. Private limited company versus proprietor, partnership or an LLP. The tax rate in a private limited company is as low as 17% to 26% when in comparison to partnership firm and LLP, which is around 31%. The proprietary firm is also no good. The tax rate, if your income exceeds rupees 10 lakhs, it is 31% to 47%. Hence, private limited form of a business is much useful to save tax in compared to a partnership firm or an LLP. Further, if you are a newly manufacturing company, the tax rate is as low as 17% if your business have commenced before 31st March 2023. Salary and rent payments to directors and partners. The business can also pay salary to the directors of the company and to the partners of the partnership firm. With this, the advantages of lower income tax of 5% and 20% applicable in the hands of individual directors or partners up to 10 lakhs rupees can be taken advantage of. Further, the company can also pay rent to the directors of the company if their building is used for office of the company. The rent received by director can enjoy a flat 30% standard deductions, which save a lot of income tax to the company. Buyback of shares against the dividend. As per the provisions of Income Tax Act, the dividend declared is taxable in the hands of the members of the company. Assuming the shareholder is in the higher tax bracket, then the same would be taxed at 30 to 47%. This can be minimized by the company if it buybacks its shares. The buyback of shares is nothing but company buying its own shares for a consideration. The buyback of share is not taxable in the hands of the company, but it is taxable in the hands of individuals as it is a transfer of capital assets, attracting a capital gain tax of around 21%. Hence, it would be appropriate if a private company buy back its own shares rather than issuing dividends to enjoy lower rate of tax. Investment in shares and mutual fund. It is advised that at least 15 to 20% of your investment should be in stocks and mutual fund. This is my personal advice and not a compulsory. The gain made in buying and selling of shares is only in between 10 to 15%. The short-term capital gain is taxable at the rate of 15% and the long-term capital gain is taxable at the rate of 10%. Further, a long-term capital gain of rupees 1 lakh is exempt in the hands of shareholders every year. This rate is much lower when compared to tax in the hands of the business, which is around 31%. Floating of Hindu undivided family, also known as HUF. Any married individual being a Hindu can create a HUF. This HUF can be used to create a corpus and the money can be used to give on loan to the partnership firm or an LLP. With this, an advantages of lower tax rate in the hand of HUF up to rupees 10 lakh rupees, which is taxable at the rate of 20%, can be taken advantage of, instead of paying high income tax at the rate of 30% in the hands of partnership firm or an LLP. Do like and share the video if you think this content is useful to your friends. For more informative videos, do subscribe my channel. This is CA Jithendar Patel signing out. See you in my next video.